10 days ago, I uploaded the video calling $1.80 the death line for Polkadot. Well, look at the chart. We lost it. We wicked right through it. If you followed standard retail logic, that was your signal to sell everything and walk away. But I'm not selling. In fact, I just added to my position. Why would I buy a breakdown? Because when you zoom out to the 2-week time frame, you realize that the market might be engineering the ultimate bear trap exactly at the 1618 Fibonacci extension. The death line wasn't the bottom. This is. Today, I'm going to show you why this specific 10-cent difference changes the entire mathematics of the trade, why the January upgrade is the catalyst nobody is pricing in, and exactly how I'm splitting my strategy between a short-term trade and a long-term moonbag. Let's be brutally honest with each other. The last 2 weeks have been brutal. In my previous breakdown, we looked at the psychological support at $1.80. Breaking that level has shifted market sentiment from fear to total apathy. You can feel it in the comments. People aren't even angry anymore, they are just indifferent. And historically, apathy marks the bottom far more reliably than panic does. We are currently trading around $1.70. This is significant because we are now fighting with the absolute lows. The price action since August has been a relentless bleed, respecting a steep descending trend line that has suffocated every single relief rally. But here is why I haven't stopped out yet. While the psychological level broke, the structural math remains intact. We are sitting on a critical Fibonacci extension that often acts as the final reversal zone for institutional accumulation. If we lose this, I will be the first to admit the short-term thesis is dead. But right now, the risk-to-reward ratio for a long position has actually improved because our invalidation level is so tight. Before we get into the charts, we need to understand why this asset is worth buying, because the fundamental picture is shifting drastically just as the price hits the floor. The market is pricing Polkadot as a ghost chain, but the actual development activity tells a completely different story. We are weeks away from the most critical infrastructure upgrade in the project's history, and it's being completely ignored. Look at this update from Parity Technologies. They have confirmed that smart contracts are entering their final release phase. The Revive upgrade is scheduled for a referendum in early January 2026, with enactment around January 20th. This brings full Ethereum compatibility to Polkadot. For years, the biggest barrier to entry was that developers had to learn Substrate. That friction disappears in January. Developers can deploy unmodified Solidity contracts using tools they already know, like Foundry and Hardhat. This upgrade is timed perfectly with the new USDC integration. You can now transfer USDC directly to Coinbase and Binance via Polkadot. This fixes the liquidity fragmentation that has plagued the ecosystem. We are also seeing signs of life in user adoption. The Pudgy Party app just hit 1 million installs, proving that consumer-facing apps can scale here. However, I value transparency, so we have to look at the bad data too. According to the Phoenix Group's developer report for 2025, Polkadot's full-time developer count has dropped by 11% to 471. That is a concern. While Ethereum and Base are growing, Polkadot lost talent. But, looking at the staking data, we are still the third largest chain by staked value, with $1.4 billion locked. The thesis is simple. The developer drop is backward-looking data. The Revive upgrade is forward-looking opportunity. We are betting that the introduction of easy smart contracts will reverse the developer trend while the price is undervalued. Now, let's get into the technicals, because this is where the money is made or lost. I'm looking at DOT on the 2-week time frame. First, let's address the trend lines. We are tracking 3 descending trend lines, marked in orange on my chart. The first one, from the December 2024 top, was broken in August. But that breakout failed, and price rolled over. Now, we are retesting that broken trend line as support. This is a classic breakout, fakeout, retest pattern. Here is the magic number, $1.70. I have anchored my Fibonacci retracement from the lows of $3.57 to the highs of $11.65. The 1618 extension, the golden ratio for downside targets, sits exactly here. This is why I didn't panic sell at $1.80. The algo targets were likely set to $1.70 all along. We are also seeing a massive falling wedge pattern. This is typically a bullish reversal pattern, but it needs confirmation. The Heikin-Ashi RSI is oversold and pointing down, similar to the setup we saw in October 2023. Back then, we broke a descending RSI trendline and rallied 200%. Right now, we are still below that trend line. We need to see the RSI curl up and break the orange dashed line to confirm momentum is returning. My strategy here is aggressive. I'm treating the zone between $1.70 and $2.50 as my final load zone. I have been dollar cost averaging down since $4, which I know is painful, but this is where the discipline kicks in. Let's talk about invalidation, because this is crucial. If Polkadot closes a weekly candle below $1.70, the trap has failed. That would open the door to the 2618 extension at 52 cents. That is a disaster scenario for traders. If you want to leave some margin, I'd suggest $1.60. However, if this level holds, the upside is significant. The volume profile shows a point of control at $4.15. That is a magnet. My targets are structured. First profit taking at $3.60, the previous breakdown level. Then $5.60, the 618 retracement. And finally, $11. So, here is the specific execution plan. And please listen carefully, because I'm splitting my strategy into two distinct buckets: the trade and the investment. Bucket 1, the short-term trade. I'm buying fresh capital in this $1.70 to $1.80 range. For this specific capital, I have a hard stop loss on a weekly close below $1.60. If we lose this level, I'm cutting this trade to protect my cash. I am not riding a leveraged position down to 50 cents. If we bounce, I'm trimming 30% at $3.60 and moving my stop to entry. Bucket 2, the long-term moonbag. I have been covering Polkadot since it was $4. I have a core position that I'm accumulating for the next 5 years. Even if my short-term stop loss hits at $1.70, I am not selling my long-term bag. I fundamentally believe in the interoperability thesis and the January upgrade. Selling a Layer 1 infrastructure project at all-time lows because of short-term price action is how you lose generational wealth. If it goes to 50 cents, I will just buy more for the long-term portfolio. But I'll not risk my trading capital to get there. Distinguish between your trade and your investment. One has a stop loss, the other has conviction. We are standing at the edge of the cliff. Most people have already jumped off, selling their bags at a loss. But the data suggests this $1.70 level is the institutional line in the sand. I want to hear from you. Do you have a moonbag you will never sell? Or are you purely trading these levels? Let me know in the comments. And listen, markets move fast. If we lose this level on the weekly time frame before the next video, I will post an emergency update in my free Telegram group. I posted this chart there hours ago, so the members are already prepared. The link is in the pinned comment. If you want to see another altcoin that is setting up for a massive move in 2026, along with Polkadot full story, watch these videos on the screen right now. It complements this Polkadot trade perfectly. Much love for watching, never financial advice, and I will see you there.